Andrew Milligan, head of global strategy at Standard Life Investments, where he helps manage what, $260 billion worth or so? Something like that, from Edinburgh headquarters.
Thank you so
Good to
much.
see you in Hong Kong this morning, Andrew. Before we talk about the Oscars, let's talk about something serious, right? Yes, we have to, I know, Andrew. But the markets, as I mentioned, the best start to the new year since 1991. So we've seen, what, 10, 15% gains?
Right.
Or we see another 10%?
20% since the low in November, of course.
Right.
May I just remind us, we started the year very, very well in 2011, and look what happened after that.
Exactly.
Volatility.
I've been bringing that up as well.
Message number one to clients, volatility. It's been here, it will stay here, it will continue. So, yes, of course we could see markets move higher. I mean, the chartists are already warning that a number of markets are getting overbought, but yes, it could get another 5 or 10%. But, I mean, this is tail end, I think, of this rally. You've got to wait for a dip now to start putting money into the market to get some decent returns. How much of a dip? For like 5, 10% or so? I'm sure we'll see 5 10s, and I'm sure we'll see 10 or 20s. We know in our publications, which I know that you've read avidly.
Absolutely.
We're talking about all the election risks this year. I mean, what on earth is the US going to do with fiscal policy? Nobody knows. There's considerable uncertainty about future QE, China. The earnings figures are not as good as some of the investors and analysts would like to see. I think we're going to see lots of volatility.
Yeah, you haven't even brought up Europe yet. I mean, that's what they're arguing, wrangling about in Mexico City, aren't they? So what about the Europeans? I mean, could that derail the gains? Could we go
yes.
Yeah?
Yes. I mean, the problem is that the politicians are just about managing to control Greece. Clearly, they have not yet sorted out Portugal, as 12% bond yields tell us. But the big issue with Europe is there's no growth plan at the moment. We are still simply saying, cut, 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 cut. And by the way, Germany, you're all right, aren't you? Right. We've got to have some sort of growth plan for Europe, because otherwise the big elephant in the room, Italy, its bond yields are too high, it's not growing quickly enough, its debt mountain really could get problematical. So, I mean, there's just a perfect example of they can control the short term, they haven't yet sorted out that longer term plan for Europe.
Yeah, that's interesting, because some people said that Italy, in their view, looks a little ring-fenced with the LTRO. We're going to get another tranche pretty soon, this week. No? You're shaking your head at me.
Well, yeah, LTRO is good, of course. I mean, better it is than it isn't. But it's a short-term palliative. All it's doing is providing a little bit of support to the banking system in Europe so they don't deleverage too quickly. But as we saw with European Commission forecasts a few days ago, we're still talking of basically flatlining at best for 2012. You do not sort a debt problem out by flatlining year after year after year.
That's right. For instance, Greece, 5 years of recession already for that country, and look where Greece has gone, right?
And the risk absolutely is, with the population realising another 5 years of recession, almost certainly we're going to have not just private sector involvement, but OSI, official sector involvement, and that's going to be a big worry for many investors as they begin to realise their central banks are going to have to take a hit of some sort. That feeds through to the taxpayer and the next crisis.
So, Andrew, what are you telling me before we get to commercial break? Are you saying that you're shutting down some positions right now, reaping some profit?
No,
or?
As a long-term investor, actually, we're adding a little bit of risk here and there. But the two big messages are, firstly, some markets are very expensive. Government bonds is a prime example in many countries around the world, so prefer your corporate bonds to your government bonds. And the second is, yes, the world economy is getting a little better, so add a little bit of risk. We like America, we slightly like Asia, we don't like Japan, and we don't like Europe at the moment. But very selective risks that investors need to take on board. This is not a time to add a lot of risk.
You were saying before we went to break you don't like Japan, but Japanese shares are rising today.
I know.
And we're at a 9-month low for the yen.
And it's one of the issues that we need to think about. And it comes back to the Bank of Japan. We know what they've said. Do they mean it? Are they really going to push through? I mean, we all agree that if yen-dollar was 90 rather than 80, the exporters in Japan, a lot of the blue-chip companies, their share prices would be dramatically different.
Right.
Do we really think that they're going to follow through on 1% per annum inflation? And
how do you get there from negative
Absolutely.
When deflationary
and we've been in this
pressures.
so many situations, so many times before. The politicians do put pressure on the BOJ, and like a mollusk, it just sort of grudgingly moves.
So what's going to change your mind then? What has to happen in Japan before you say, okay, I'll buy into it?
I think if they follow through with this 10 trillion, and then if we saw another 10 trillion by the summer, i.e. they're really beginning to pick the pace up, But watch what they do, not what they say, is one of my personal mantra with many official people.
Right.
And they have said 10 trillion this year. Do they actually follow through with that? And do they pick up the pace with that?
Okay, now you say you're mildly positive on Asia. What does that mean? Are you selectively Asia?
Very selective,
Sector-wise or country-wise?
Country-wise. I mean, sectors we leave to our fund managers to pick and choose between. Well, they don't really do sectors nowadays. It's absolute company picking. Australia, a bit worried about the currency, a bit worried about the bubble in some of the mining areas, of course. Korea, we really quite like.
Korea?
Yes,
yeah.
It's the one's doing quite well, competitive, picking up global trade. If you think this is going to be a year where there's a bit of a global recovery, Korea could well benefit from that. Some of the oil producers would be something to think about, of course, with everything that's happening in the oil price, so perhaps think of a little of Malaysia. Indonesia, some good domestic demand stories. Japan, we've just talked
China,
about.
I didn't even hear you talk about China.
No, China actually we're relatively positive about. But again, do you say buy China? Well, do you want to buy the property companies? No. The banking stocks? No. Construction companies? Perhaps. Do you want to buy anything related to domestic demand, wages, recruitment, consumer, either the high end or even the mid ends now? I mean, some of the wage increases that we're seeing being delivered by some of the better companies in China, very noticeable indeed. Not just in terms of outsourcing from China back to America and Mexico, but for the domestic demand that we can see for some Chinese stocks. So from our point of view, really picking and choosing quite carefully between countries, but even more so for our fund managers, who there's very little sector bias in what they do
So
now.
it seems like consensus globally is to buy America then, buy the U.S. recovery.
Yes, although I think the longer that goes on and gets more entrenched, then you do start buying more Latin America and you do start buying more Asia as the beneficiaries of that. One of the good things about America is that it does seem to be coming through in terms of getting its banking sector in order. It's not yet healthy, but it is healthier than it was, and certainly better, of course, than the banking situation in Europe. And we're beginning to see some credit demand, particularly for small, medium companies. And perhaps this is a year of self-sustaining growth. Not wonderful growth for America, but self-sustaining.
Something like that.
Well, certainly north of 2.
Okay.
And tell us a bit about this G20 meeting in Mexico City. It seems like everybody ganged up on the Germans.
I'd quite like to.
Well, you would say that, wouldn't you, Andrew? But tell us, why do you think they're so kind of ticked off here?
Well, they've done the essence of solving the problem facing Greece, but the difficulty is that if there's any further official sector involvement with Greece, or if we start to get worried about Portugal, its bond yield is still 12% or so, you need firewalls in place to prevent contagion. And despite what Mr. Schäuble might say, nobody believes him that the firewall's already there. Lautro is helpful, but basically we do need a larger EFSF, ESM, and 500 to 750 is the bare minimum. You really, I mean, we've been talking of 1 to 2 trillion is what we'd like to see. What we want is, if an event happens, the markets yawn because the walls are so high that nobody really worries. And at the moment, we're nowhere near that at all.
OK, what about the LTROP, as you mentioned? That we've got another round of that this week coming up. I think it's on the 29th, so we can't have an anniversary, at least for 4 years of it. But did it work last time, in your opinion?
It's been
That's the general consensus. Did we really need the second round?
Oh, yes, yes. I think it is still essential. Nobody really thinks that the European banking system is anything other than in a weak way, as some of the figures from Credit Agricole and BNP have shown this week. Yes, we do need another. How large it's going to be, I think there's an immense debate, of course. Is a low figure good or is a high figure good? But we need quantitative easing from the ECB. They can't do it officially in the same way.
But we still don't know what some of these lenders did with this money, right? So what do we even know what's going to happen with the second round?
Oh, absolutely. I think with some, they have simply bolstered their balance sheets. Some are doing carry trades. Some are in a very difficult way, can't go to the markets. And therefore,
I think a disproportionate of them did the carry trades.
Well, probably, but I mean, that's no bad thing. That's what quantitative easing is, manipulating markets to give banks a profit to help them get back into some semblance of normality. But it's going to be several years for European banks. US banks are probably 2 to 3 years further advanced than their European counterparts, even if we continue to see more Lautro. I don't think this one matters.
Right.
My question is, are we going to see another Lautro in the summer and another one in the autumn? Because that's what I would love to see, is the ECB moving further down this path. Whether they do...
So there's no expectation, though, that we're going to get this firewall at the EU summit later this week. It's simply not.
No, I don't think too early. But Germany responds eventually, either in a crisis or when there's sufficient persuasion from its neighbours. So I think Germany will eventually agree. When there's been some give and take, we'll come through with larger numbers.
You know, we've had the best start to the new year since 1991. Yes, global stocks. But if you take a look at the earnings and the performance so far, I mean, people are ratcheting down their estimates. So, you know, are these gains? Yes, that's right.
I think gaps are opening up. And that's why, as you and I were talking a little earlier, I think it's very likely that we will see stock markets begin to fall back. The US earnings season only coming in about +3. The consensus forecast for the whole year is +10, which we think is too high. We think we'll be lucky if it gets to +5 this year. There's lots of pressure on the cost side beginning to come through. Wages in China, oil, etc.
Yeah, how do you advise your clients to make sense of these market inconsistencies with, you know, the Dow at 12,000 or 13,000 and then, you know, U.S. Treasuries at 2% and then you have Brent crude at 125 and then you have low vol? How do you go about these inconsistencies and making sense of them?
Well, I'm very glad that you talked about the US Treasury at 2, because I think that's the centre point to focus on. What can you be certain about in a very uncertain world? Right. We know government bonds are expensive in many countries. Why hold them unless you really are so concerned about the way forwards? And then you go down through the list. I don't want government bonds. Do I want corporate bonds? Yes, because an awful lot of companies are making profits, and I'm very happy indeed to hold their corporate bond, or even perhaps their high yield if you're a little happier about the world. Equity, and then we start getting a bit, I perhaps like this country or this sector and not liking others. Commercial property, not wonderful at the moment with everything that we're seeing. So you go down through the list. Where am I most certain? And I'm most certain I don't like government bonds. And where am I more certain? I think companies will make profits this year. They will repay their corporate debt. So why don't I buy some corporate debt?
Andrew, I just want to get a different sort of view, because you visit here twice a year, don't you, roughly? And so, you know, you must have a snapshot of what things are like and how things have changed and evolved in Hong Kong and the region. Give us your view on that.
I'd say, firstly, the vibrancy and the energy and the enthusiasm is marked compared with Europe, where we're talking about, you know, where the next crisis is going to be. But some of the problems of inflation in Asia are very apparent each time I come. It's usually in the property market, but as we were talking a little earlier, the wages side as well. We are seeing some of the pitfalls of growth appearing, and those come through more and more and more. Now, I think the good thing for global investors like myself is there's getting a more balanced view about what's going on in Asia. Because in the past, some people have said simply, I want to buy an emerging market, let's go and buy Asia. And not actually doing their homework.
Why don't you buy frontier markets, because they're not doing very well this year? Frontier, Bangladesh, Sri Lanka. That's right.
I'm very, very happy for people to look into those markets, because part of the difficulty as a global investor that we face is most of the big issues in the world are talked about. You do a very good job to talk about the G20 and what's going on in Greece and such like. Very little coverage of the Bangladeshis or the Egypts or the Nigerias. So for a retail investor who wants to do their homework, I think frontier markets is a very, very good area. But let's remember they're called emerging for a very good reason.
Frontier.
Yes. Not submerging like certain ones in Europe.
They will submerge eventually. Hence you really need to do your homework. But that's where the market is often less efficient. The US stock market is a highly efficient market. The news goes in instantaneously and is priced in well. Not the case in other markets. So for a retail investor, think about markets where there's not quite so much.
What have we got? Fantastic Flying Books wins Oscar for animated short film. That's the latest.
You've seen it, right? Christopher Plummer wins Best Supporting Actor, oldest to ever receive an Academy Award.
82, I think?
82, yes. Older than Jessica Tandy when she won for Driving Miss Daisy.
And isn't it nice that, you know, ageism doesn't matter so much in the cinema? Yes, wonderful.
And the probability of the artist winning Best Picture?
Well, I saw it the weekend, and you've seen it twice, haven't you?
I would love it if it won.
Really
I need to watch it. I'm so excited it's in Hong Kong.
Okay, but, you know, we want Meryl to win, don't we, for Best
Actress?
We do.
Meryl.
Go Meryl. But, you know, she's up against some pretty stiff competition there.
Sadly.
So we'll see how she does. But, yeah, any bets for you?
No. I think the answer is 1 to 20 at the bookies in the UK at the moment. So if you put $20 on it and it wins, you win $1. So
yeah, so it's pretty much a shoe-in, isn't it?
Exactly.
All right, there you go. But, Andrew, good to see you on your twice-yearly